You thought hard money lenders were just expensive band-aids for desperate flippers, didn't you? Well, buckle up, because what if I told you that in certain scenarios, these supposedly predatory loans could actually save you more money than your friendly neighborhood bank over the long haul? And institutional investors already know this dirty little secret. Here's the thing everyone misses. Banks aren't giving you money out of the goodness of their hearts. They're renting it to you with strings attached that strangle your returns. When you factor in appraisal delays, inspection requirements, seasoning periods, prepayment penalties, and those soul-crushing 6 to 8 week closing timelines, suddenly that 9% hard money loan starts looking like a Ferrari compared to the bank's rusty bicycle. Let me break down the math that'll make your accountant weep with joy. Say you find a distressed duplex listed at $150,000, but the seller needs to close in 2 weeks because they're facing foreclosure. Your bank laughs at you, but your hard money guy wires funds in 5 days. You close the deal, and that property's worth $220,000 after a quick $30,000 rehab. The hard money costs you 12% interest plus 3 points up front, so you're paying roughly $18,000 over 6 months. Meanwhile, your buddy, who waited 3 months for bank approval at 5%, just watched that same property get snatched by another investor. His savings on interest cost him the entire deal, worth $70,000 in equity. But wait, there's more to this plot twist. Hard money lenders don't care about your debt-to-income ratio, your tax returns from 3 years ago, or whether you've got 17 inquiries on your credit report from buying too many limited edition sneakers. They care about one thing: the asset's value and your exit strategy, which means you can stack deals while your credit-dependent competitors are still filling out paperwork. Here's where the skeptics come in, sharpening their pitchforks. But the interest rate is insane, they scream into the void, clutching their amortization schedules like security blankets. They're not wrong about the rate, but they're dead wrong about the real cost. Because in real estate, time isn't just money, it's your entire profit margin walking out the door. Think about the psychological warfare banks wage on your confidence. You find the perfect value-add opportunity, you run the numbers 17 times, you submit your application with the enthusiasm of a kid on Christmas morning, and then you wait. And wait, and watch that deal die because the seller accepted another offer while your loan officer was on vacation in Cancun. Let's rewind to 2008, when everyone learned this lesson the hard way. The investors who survived weren't the ones with the lowest interest rates. They were the ones with the fastest access to capital, the ability to move when blood was in the streets, and the guts to use expensive money to buy assets at 70 cents on the dollar. Banks were hiding under their desks. Hard money lenders were printing checks. This pattern repeats itself every single cycle, yet somehow we act surprised each time. When opportunity knocks during market dislocations, recessions, or those magical moments when sellers panic, the investor with pre-approved private capital wins, while the bank-dependent investor is still scheduling their third property appraisal. Now, let's address the elephant wearing a banker's suit in the room. Hard money is predatory. Sure, some lenders are shadier than a palm tree convention, but painting the entire industry with that brush is like saying all restaurants are bad because you got food poisoning once at a gas station buffet. The real predator is opportunity cost, that invisible monster that devours your wealth while you're busy feeling good about saving 2 percentage points on interest. You know what's expensive? Watching 10 deals pass by because you're waiting for conventional financing while paying rent on your apartment and scrolling through investment property listings like they're a dating app you're too scared to actually use. Here's the actionable wisdom our grandparents somehow knew instinctively. Expensive money that gets you into cash-flowing assets beats cheap money that gets you nothing. Position size matters more than interest rate. Better to own 5 properties at 10% interest that generate cash flow than 0 properties while you wait for the perfect 5% loan that never materializes because you don't qualify or the market moved. The smartest operators I know use hard money like a sprint, not a marathon. They close fast, add value faster, then refinance into conventional loans once they've forced equity and can show stabilized cash flow, essentially using expensive capital as a wedge to pry open deals that create enough value to dwarf the borrowing costs. Let me hit you with some philosophical truth that'll keep you up at night. The question isn't whether hard money is cheaper than bank loans, it's whether you're asking the right question at all. The real comparison is hard money plus a deal versus bank loans plus no deal. And suddenly, the math looks very different when you're measuring against zero instead of against some theoretical perfect scenario that exists only in your spreadsheet fantasies. The market doesn't care about your feelings, your credit score, or your carefully crafted 5-year plan. It cares about who can execute, who can move capital efficiently, and who understands that the best deal at 12% interest obliterates the mediocre deal at 4% every single time. I've made peace with using expensive money when it makes sense. Just like I've made peace with the fact that sometimes the wrong decision executed quickly beats the right decision executed never. What matters is running the numbers without emotion, understanding your exit strategy, and having the discipline to walk away when the math doesn't work, regardless of how sexy the interest rate looks. At the end of the day, consistency beats perfection, and a track record of closed deals beats a filing cabinet full of rejected loan applications. Whether hard money is cheaper long-term depends entirely on what you're measuring it against. And if you're measuring it against doing nothing while you wait for ideal conditions, then yes, it's infinitely cheaper than the opportunity cost of paralysis. If you're ready to stop theorizing and start finding actual investment properties that justify whatever capital you can deploy, head over to www.growthsense.com, where investors can find investment properties and sellers can list their investment properties for serious buyers who understand that execution beats hesitation every single time.